Again, my name is Dale Brethauer. I've been a trader for 30 plus years. A lot of the experts, when you're listening to an expert, you need to ask yourself, is this a doer or a teacher? And I am both. I've done this for 30 plus years. I am a success. This is how I make my living. I am a hedge fund manager. But recently I've got into teaching because I've made my money and I think it's time to give back. This is not an easy way to make a dollar. The stock market, to be a professional in the stock market is no easier than a brain surgeon. A brain surgeon's got to go through years and years of training and practice before they become a professional. Don't expect to make a lot of money overnight. This is not get rich quick. What you need to do when you finally put your hours and your time in, you need to make a consistent profit, just like Steve was talking about in the presentation before. Professionals look for consistent returns all the time. Okay? Not big home runs, consistent returns. That's what I'm going to be talking to you about today. Credit spreads, bull puts, bear calls, iron condors generate income on a monthly basis. Not tons of money, steady income on a regular basis. That's what we want to do. What I'm going to talk about is the time value decay of options, the advantages of this strategy. In layman's term, what is a bull put? What is a bear call? What is an iron condor? How do you make money with these credit spreads? Well, there's three ways. And when you pick a direction, if you have just a straight call, there's one way. It's got to go up. And not only does it have to go up, it has to go up in a certain time frame. See, with credit spreads, it can go up. It can go sideways or it can come down a little bit if you've got a bull put. And time is working to your advantage. So there's three ways you can win with this. That's the advantage. Which credit spreads are worthwhile using? How do you mitigate the risk? Then I'll show you some actual trades. I'll show you a bear call, a bull put, and an iron condor, how they were set up. I'll show you some long-term trading results that was done by one of my mentees. This is an independent study done by one of my mentees, and therefore I think it has more credibility than if I were to show you something. And you can see the power of this over a 10-year period. Then we're going to talk about generating income and financial freedom. Now, as I go through here, if you've got a question, I'd rather try to answer it right then rather than waiting till the end. So go ahead and type in your questions as we're going through, and I will try to get to them as I'm going through the presentation. Okay, this is a typical option chart. It shows the rapid decay during the last 30 days. Okay, an option is based with real value and then time value to get to the premium of the option. The time value decays every day as you get closer to expiration. The last 30 days is an exponential drop. And this is where we're trying to sell. We're going to sell the premium, looking for that, excuse me, the theta decay, and that way we're going to take that decay and put it in our bank accounts. It doesn't happen all at once. It'll happen over the last 30 days. Now, the advantages of this strategy is you don't have to know the market direction. You can profit when the market's going up or comes down. It yields monthly income on a consistent basis, and these are high probability trades. Very seldom do you hear a strategy where you're talking about 75, 80% profitability. That's what these trades yield. You don't have to be constantly watching the market. It's a low anxiety because you're covering a longer time period and you're selling premiums, so the time is working for you. The trades are not concentrated in a certain price level. So the market can move. The market doesn't just go straight up and straight down. It goes up, down, sideways. And within a range, that's what we're looking for. You have good return and controlled risk. John says all is fine until you gap through a sold option, and that's one of the reasons why I don't use stocks. I'm going to use things like the RUT and maybe some of the bigger stocks. And when we get close to earnings, you got to watch out. Earnings on Priceline and Amazon sometimes will really kick through, and it'll shoot right through there. That's absolutely correct. Okay, the strategy takes advantage of the theta decay. And what we're going to do is, if you sell an iron condor is basically a bull put and a bear call. Okay, it's the bull put, bear call. The bull put is a bullish strategy. The bear call is a bearish strategy. You put them together and you get an iron condor. Not always. I'd like to get an iron condor because I can get double the credit, but not always is that going to be true. Here's a definition of a bull put spread, and I know these charts are hard to see, so I'm not going to really focus on that. But this is what I'm looking at here is the price of the RUT, and what you see here is a regression channel. I know Steve was talking about it's hard to pick overbought, oversold. However, the regression channel is based on statistics, and statistics say that if you're plus or minus 1 standard deviation, 66% of prices will be contained within that channel. If you're within plus or minus 2, and that's the gold, 95% will be contained within that channel. Now, I understand what he was saying about the 50-day moving average line, and sometimes you have to just stay with it until it moves around. But this casing, if you will, it's kind of like a sausage, and you got the meat in the middle, and you got the casing here. When you have something that contains 95% of all prices, you've got a pretty good indication of when to put on a bullish strategy, and this is when you would put on a bull put spread. And the example here is what you would do is you would go way out of the money below this point, and you would sell. You would sell the 950 put. Now, I don't want to sell naked. You look at that and you say, wow, you know, the theta decay is so rapid, you can make a lot of money with selling naked. You can, but the market makers are going to charge you a lot of margin. The brokers want you to put up a lot of margin if you're going to sell naked because of the risky options you've got there. If you go ahead and sell one and then buy one a little further out of the money, you have downside protection. You have downside protection from that catastrophic drop. Okay, and you come up with a lesser net credit, but the margin requirements are less for this than it would be to just sell this naked. Okay, so what you're doing is you're deciding, first of all, this is an area that I want to put on a bullish strategy. The second thing is to go pretty far out of the money, and I usually use on the option chain, I look at a delta of about 0.10, 0.10, Okay, and that basically is saying that has got about a 90% probability that it will expire. Okay, so it's a very high probability trade. You're not going in here and trying to grab boatloads of money. You're trying to be consistent. You're trying to have a nice return, but you're not trying to have a windfall. Okay, so a bull put, again, is a bullish strategy where you look at it and you go underneath the market and sell, but then buy one further out. A bear call is just the opposite. A bear call is when you want to put on a bearish strategy. You think it's possibly overrun, overbought. Okay, you're giving yourself a chance here because the one you're going to sell is way out of the money. It's not right in this area. It's way up here. Okay, so you're selling at 1270, you're buying at 1280, buying one further out to give yourself a net credit. Now the iron condor puts them together. This is a risk profile. This is a risk profile of a bull put. This is a risk profile of a bear call. You put them together and you've got to try to keep the price within this channel. Okay, it's a little bit tougher to accomplish. Of course, everything is risk and reward. Okay, and it looks like an iron condor, and here are the wings, and it's in flight. Okay, here's the example of the iron condor. Not only do you have a net credit on the bull put, you have a net credit on the bear call, so you're basically doubling the credit possibility. Let's see, Roger's saying, often I find it difficult to structure a bull put credit spread that provides a reasonable yield. Okay, I'm going to be showing you, Roger, which things I look at. I look at the RUT, I look at the big boys, I look at Google, I look at Netflix, I look at Priceline. Okay, and they're the ones that have the big credits. You say, I got hung up on, say, a credit of 7 cents. I never do one for 7 cents. Never do one for 7 cents. I'm always looking at about $1.50, $2, something like that. You need a large credit. You're taking some risk and you need some reward. Okay. You can profit with a bull put if it goes up, down, or sideways. Okay, and here's just a chart of a random chart of PepsiCo. If you put on the bull put right here and it goes up, that's great. But then it came back down here. You were still okay with that. As a matter of fact, you were making a little money, and then ultimately when you got out, you were making the full amount. And let me show you that. When you first put this on, you sold. Remember, you're selling this vertical. You sell a bull put, okay, for 70 cents worth of credit. It goes up in your favor. The credit goes down. That's good. That's the decay. I'm always selling out of the money options, so the only part of the premium is time value. Okay, so this time value is decaying as it goes up. Time value is decaying. Okay, then it actually came down below the point where I put it on, and we're still making money. Hey, we're not making a lot, but we're still making money. We're still in the game. And then finally we come out here and we make 84% of the total potential that we could have made here. Now the same thing's true on the bear call. If you put on a bear call here, you can profit when it goes down. Here it goes back up, and finally it goes down. Let's take a look at that one. Okay, we had $1.25 worth of credit. It goes down in our favor. We pick up 67% of the total potential. Then it goes back up above where we got in, and you're down 21%. A lot less than what you'd be down if you were actually selling the if you were actually buying a put. You would actually be down a lot more than that if you were taking. But if you take the strategy of a bear call, which is a bearish strategy, you've got that protection. And finally, when it comes all the way down here close to expiration, you've got 100% of your potential return. Now, Roger, to go a little further into your question, you know, what credit spreads are really worthwhile doing? And I only trade the big boys, and that's something that's $300 plus per share. And what I did on this chart is you can see that I set up bull put spreads about 43 days left until the September expiration. I sold them at a delta of 0.10 with a 10-point spread. And you can see this is the credit spreads I was getting on Amazon, Chipotle, Google, Netflix, and the RUT versus the credit spreads you can get on a DuPont, a Nike, a Verizon, Starbucks. These, in my mind, are not worth the risk of putting on this strategy. I only trade the big boys. Ron says, where is the risk area? Well, if you look at this, on the bearish side, if we sell a bear call, first of all, you're going to sell it way out of the money, so it's going to be up around here, Ron, that we're selling, and then we're buying one further out. This is Apple. So the risk is that if it goes above there before expiration, that's the risk area. Now, if it gets close to there, you might be losing money, and you don't have to watch this on a daily basis, but if it gets to a point where, and I know, I call it my uncle point, and I watch it on the risk profile, and if it gets close to the uncle point, if I don't see a reason to stay in the trade, I will just get out, Ron. A successful trader has to learn you're going to have losers. And how do you handle the losers? That's the key. Okay, good, Roger. I'm glad that answered it. How many days out do you buy the spread? Jake, usually I'm looking about 40 days out just to take advantage of that last 30 days. And most times I'll set that up right around 40 days. Most times, about a week and a half, 2 weeks out, I'm getting out of the trade. When you get into the last week of these, they get very volatile and they can move quickly. So I want to be out by then. Okay? Do you place stops on your credit spreads? Absolutely not. Absolutely not, because when you put on the credit spread, first of all, you want to put it in at the midpoint. In other words, you don't want to do the bid and the ask. You want to do the midpoint. You don't want to do it at market. If you put a stop on a credit spread, it's going to be executed at the market, and you're not only going to lose where you thought it was, but you're going to lose the difference between the bid and the ask, which are usually pretty big spreads on the RUT and some of these big boys. Okay? Do you adjust the trade when it's going wrong, or do you just get out? Ken, I'm either in or I'm out. If it goes against me a certain amount, and I can't give a reason to stay in the trade, something has gone wrong, I'm out. I'm not going to throw good money after bad. I'm either in or I'm out. Good question. Okay. How do you mitigate risk? Well, first of all, you have to trade the right instruments. We talked about that, and I focus on the RUT, Amazon, Chipotle, Google, and Netflix. I always go with a 10-point spread because you can get a nice credit for that. In other words, you sell the if you're selling the 660 put, then you're buying the 650 put. Again, my entry is about 40 days. Here's where I'm entering, right around a delta of 0.10. Okay, and that gives me a high probability trade. The returns are not as great as they could be if you get closer to at the money, but it's a balance of risk reward, and I think this is a trade where you got to be very careful and you got to stay out of that risk area. Yeah, occasionally you'll get in it as long as you know that you're going to be in and out. Don't worry about it. Michael, interesting. Why don't you use very short-term trades on the weeklies? Okay. I love this strategy. And when the weeklies first started coming out a couple 3 years ago, I immediately thought, hey, there it is. But the weeklies move so fast, especially if you have on an iron condor. If you've got 30, 40 days till expiration, it can go up strong and then pull back, and you're back in the ball game. On the weeklies, if you have a strong move in one direction, you're out. You're out. You don't have a chance. You don't have time to come back. Weeklies, I think, are a little bit too fast for this strategy. The other thing is well, I was going to say the RUT doesn't have weeklies, but now it does, so I'm going to take that back. How do you get out of a trade? I thought if you were selling an option, you had an obligation to deliver the stock only if you're at expiration, Willie. How do I get out? I simply buy back the bull put, the bear call, or the iron condor. So you're selling to get in. I'm buying back to get out. And I do that well in advance of expiration, so there's no obligation to deliver the stock. Roger, when you say you don't manage the trade at all, I do, in that I'm looking at the risk profile, and I know if it's in a certain range within the break-even, I just let it run. If it's between break-even and what I call my uncle point, I've got to keep a close eye on it. And if it's beyond the uncle point, I'm out. So in that sense, I really am managing the trade. I'm just not fixing it, if you will. If it looks like I should be getting out, I just exit. For the RUT, is the IWM okay, John? The only problem is with the IWM, which is the ETF for the RUT, it's 1/10 the size of the RUT. So as you get bigger and you're investing more, the commissions will eat you up on the IWM. Okay, so IWM is a great place to learn the strategy, but as you get good at it and you want to go ahead and do this with a nice return, you're going to have to start using the RUT. Michael says I use this 2 standard deviation and it works well. It sure does. It's uncanny. It is uncanny. Okay, here's some actual trades. I got a couple more questions. I'll get to those in just a second. Robert, you're next. I'll be answering your question in just a second. Let me show you this actual trade. This was on the RUT. This was this year. It was a bear call. Why did I put on a bear call? Because at this point, this trade was, the RUT was what I consider overbought, okay, because I love the regression channel. But if you remember what Steve was saying just before me, he's looking for some kind of a breakdown of a previous low, and that's what you're getting here. Okay, this is what they call a measured move, and when you get that, when you get in there, look how far out. Remember, This is plus or minus 95% of all prices will be contained within here. Yes, indeed, you do get outliers, but look how far out I am selling. Okay, at this point, the RUT was right around looks like close to 1185, and I was selling the 1270 call and buying the 1280 call for $1.15 credit. Okay, not greedy, not greedy. Now this actually went down to the 161 Fibonacci, which is another tool I use, and I got out and took the total profit. This is a bull put on Amazon that was May-June time period, and again, it came down to the -2 on the regression channel, and look how far out we go with a delta of 0.10 to sell our bull put. Selling the 250, buying the 240, 84 cents credit. Comes up to the 161 on the Fibonacci, boom, you're out with 84% of the total. Here's an iron condor. Okay, now, how do I know what the market potentially will be doing? I don't have tomorrow's newspaper, I'm not sure, but I like the Arun indicator. The Arun indicator tells me how many new highs, how many new lows in the last 25-day period. Okay, and if both of these are going down, that means there is no strong trend. If there is no strong trend, and the price is right in the middle of the regression channel, there's a good chance it might stay there for a while. That's when you can put on an iron condor. And notice on this one, I'm getting $1.95 versus the other ones were about half of that. Okay, let me go back and pick up a couple of the questions now. What do you use for the stop loss to determine when to get out of the trade? Okay, Robert, I actually don't use a stop loss, like I said earlier, but what I'm looking at is, okay, if you have one contract of the RUT, okay, it's going to require $1,000 worth of margin to put up a 10-point spread. Okay, either for a bull put or a bear call or the iron condor. Okay, so what I'm looking for as a stop is when I lose 6% of that margin requirement. What I'm looking to profit is either when it hits a Fibonacci or I get 10%. Okay, so I've got a positive expectation trade here. I'm going to win about 75 to 80% of the time. When I do win, I'm going to win 10%. When I lose, I'm going to lose 6%. The 6% is I don't put a stop loss there because of the bid-ask thing. But in my mind, I'm looking at that's my uncle point. When I hit 6%, unless I can make a case to stay in, I'm out. Don, I hope that answers your question about the uncle point. I've been doing this for a long time. I can remember when we were kids, you'd bend one of your friend's arm back behind his back, and you'd keep applying pressure till he said uncle. And pain, it's pain. That's my uncle point. Okay, Rick says, want to leg in or out? I don't like to do that because the market can move against you. Now, if you're in an iron condor and you can see the market moving against you and you do want to get out and you're having trouble getting out, see, these don't, because of the big bid-ask spread, these don't happen immediately. You might have to stick around for 10, 15 minutes before these are executed. And if you want to get out sooner than that and you have an iron condor, I'm okay legging out by buying back the bear call and the bull put simultaneously. But I don't want to go further and leg out. I don't leg in, leg out. Willie, what do I mean by a standard deviation? It's a mathematical term that gives you an indication of, at a certain price, within 66% of the time, what will the range be on that? It's a mathematical derivation. I used to do these by hand. I used to construct my own regression channels. Trading platforms nowadays like Thinkorswim do it for you. It's beautiful. The technology for traders is amazing nowadays. Okay, here's the independent backtesting of the RUT that was done by one of my mentees for 10 years from 2003 to 2012. And what he did is he set up 40 days out. He would go to a delta of 0.10 on both the bulls, the put side and the call side, set up an iron condor, and if it hit the 6%, he would get out the next day. And if it lost 6%, he would get out the next day. If it won 10%, he would get out the next day. Very rigid rules. And he just went down and did that. And over a 10-year period, you had 75 winners and 101 losers. That's 75%. Very seldom do you find a strategy that works with that high of a percentage. Okay? And a very nice profit to boot. Consistent profit that keeps coming in month after month after month. Yeah, you're going to have a loser now and then, but when you have a consistent, when you have a string of 4 or 5 and then you have a loser, it makes it a lot easier to say, you know something, I can't make a case to stay in here, I'm getting out. It's just less anxiety. Now, Reed was mentioning Dr. Van Tharp. My trading really took a turnaround when I attended one of his webinars. When I actually went out and worked with Dr. Van Tharp for a couple days. He's a psychologist, and he works with traders. He's written a number of books. One of the books is Trade Your Way to Financial Freedom. And I want to talk a little bit about some of that. He says financial freedom is really a new way to think about money. Most people think they win the money game by having the most toys, the most money and the most toys. That's not the right mindset. I like what he has going forward. Financial freedom means that your money is working for you and making more money than you need to meet your monthly expenses. Now that's a goal that you can hang your hat on. And this is the kind of strategy that will allow you to do that. The second burger dot, it doesn't mean that you won't spend hundreds or even thousands of hours building the foundation to learn. This is an easy strategy. This is an easy strategy. What will take you time? It will take you time to master it. Once you master it, you're going to have it for the rest of your life. It does mean, however, the financial freedom is possible once you lay the groundwork. And it looks at, you go to a financial planner, and a financial planner is going to say, nope, you can't retire yet because you need this amount of money in the bank. Okay? What we're doing here is we're developing a strategy that will allow you to consistently bring money in and have consistent cash flow. I'd rather have consistent cash flow than money in the bank. Well, I actually love the stock market, so this is not only what I do for a living, this is my hobby, this is my passion. So I'm in there anyhow, and I love consistent cash flow. All of my money is not in the bank, it's in my hedge fund and my personal accounts. I believe in myself with these strategies. Okay, I've got an offer too. And what I'm going to offer you tonight is if you go to www.optionsinfinity.com, optionsinfinity.com, what I do is a nightly video blog. And I put that on from Sunday through Thursday. And it's kind of like you're looking over my shoulder as I trade the markets. Now, the beginning of this year, January of 2014, I challenged myself to return more than 100%. It was the double up challenge. I've done this in previous years, and I've got 1 year I just missed it. I had 94% return. Year to date, I've returned 134% on a $25,000 portfolio, only trading $1,000 on directional calls and puts, weekly options, and $10,000 margin requirement on the credit spreads. Okay. The blog that I do, the trades that I talk about, the trades that I manage, and the trades that I show you how to exit has returned 134% on the $25,000. Now, if you just look at $1,000 per trade, the returns are a lot higher than that. This nightly blog, I do it, I show you the charts. I use Thinkorswim. I'm not an affiliate of them, but I think they've got a fantastic trading platform. Every night I show you the trades we're in, what we should be doing, any new trades, when you should exit those trades. It's like looking over my shoulder. You'll also receive 2 hours of instructional video which shows you what I'm doing, how I do this. There's only 3 things that I do. Well, there's 4 things that I do. Most of my portfolio is in stock, okay, because stock, you don't have the time constraints, you don't have the, you have dividends, but you need a large amount of money to make money with trading stock. These strategies are for smaller portfolios trying to build to that point. This strategy will allow you to generate monthly income once you get really good at it and build up that account up. Okay, $49 a month, and it's recurring. First month is guaranteed. If you don't like it, just let us know. It's free. Okay, nothing. You talk about risk. There's no risk to you here. Again, it's like looking over my shoulder and watching me trade.